If you're over the age of 50 and you haven't begun saving for retirement, you're probably experiencing a bit of anxiety, especially when you read articles that tell you, by this point in your life, you need to have $500,000 saved or whatever. And that number just seems so astronomical and so out of reach. Well, I have some good news for you. You're not alone. My name's Kevin Lum. I'm a certified financial planner, and my goal is to help 1 million people retire without worry. And I work with retirement planning every day. And I want to tell you, you're going to be okay if you take some concrete steps today. Now, that's not to say there isn't a bit of urgency, but it's not too late to get your retirement plan back on track. Now, nothing I say in this video today is financial advice. I'm going to be giving you some strategies that I give to my clients. In fact, I charge hundreds of dollars an hour to kind of walk through some of these strategies with clients. But it's not financial advice. Before you make any changes to your portfolio or you do anything, you should talk to a financial professional. The other thing you should know is if you're looking for a video with a lot of fluff and happy sayings about it's going to be okay, that's not this video. Now in this video, we're gonna get really practical. I'm gonna pull up my screen in a little bit and we're gonna look at spreadsheets. In fact, I'll even share a link to a copy or to a template of the spreadsheet I'll be using so you can actually begin to play with this yourself. So the first thing you need to do is you need to evaluate your spending. What I find with many of my clients is that they don't know where their money is going. And so before you can get your retirement back on track, you first just kind of need to know where exactly is your money going. And so the best way to do that is to either keep a log or to pull your bank statements, your credit card statements, however it is you spend money. If you spend cash, you're gonna need to find all your receipts. If you use credit cards and or checks, that's gonna make it a bit easier. But what I want you to do is go back and find everything you've spent money on for the past 3 months. And then I want you to log that. And basically what you can do is if you have an expense, let's say for food. Food is maybe 1 month you spend $500 in grocery, the next month you spend $300 in grocery, and the next month you spend $700 in grocery. So what I'm interested in is finding the average of those 3 months. So what you do is take those 3 numbers, divide it by 3, and that should give you a good average of exactly what you're spending on groceries. And so I want you to figure out where's your money going, and then we're gonna put that, you can either write it down on a piece of paper and do it that way, or if you're comfortable using Excel or Google spreadsheets, we can do it that way. And so what I'm gonna do is I'm actually gonna pull up a spreadsheet that I use with clients, and I'm gonna walk you through exactly how I want you to evaluate your spending.
So I think we started recording here. So here's what we wanna do. So this is a spreadsheet I use. First thing is you want to enter in your after-tax income. So let's say you earn $60,000 a year, 20% goes to taxes. That leaves you $48,000. It's probably a little bit generous, but let's just say, so you have $48,000 a year that you're earning. Let's see if I can get that right. I'm gonna divide by 12 because I want to know what your monthly is. So you have $4,000 a month in expenses or income rather. Okay, so let's go over now to rent. Let's say you spend $1,500 a month in rent. And I want you to split this into a couple different buckets that I have here. So the first is your fixed income. What are your fixed expenses? These are the type of things that you just can't live without. So you need a roof over your head. You're going to need a car to get to your job. You need water, electricity, a phone. So what are the fixed expenses in your life? So we're going to look here. We're going to say $1,500 for rent, $100 for cell phone, not $1,000 for water. That'd be a bit expensive for water. Let's say $100 for water. Let's say groceries at $400. What else we got? Electricity. Let's do $150. Let's do gas for your car, which hopefully should be coming down a bit, but still a bit expensive. So let's say $100. What else? That'll get us started. So these are some of the fixed expenses, things you have to pay every single month. So right now you have a total fixed expense of $23.50 a month, but you also have discretionary expenses. So you have cable, TV, which is $50 a month. And you have, let's see, Netflix, which keeps going up in cost. So you got Netflix at $15 a month. Let's go back over here. Let's internet. I think internet's a necessity in today's day and age. So you've got your fixed expenses. These are things you can't live without. Then you have your discretionary expenses, eating out, / DoorDash if you do delivery. So let's say that's another $500. So you've got $500 discretionary. And so your total expenses for the month right now are $3,000. You have an extra $1,000. And then just between me and you, we all know that miscellaneous expenses, those little things that you spend money on, they just add up. Now, a lot of them are discretionary. The problem is we don't really know which expenses those are or where those are going. So we're going to say $750. So now we got $285. Now, the problem is we need more money because we need to be able to save for retirement because we haven't started yet. So that's the problem. So next thing I want you to do is I want you to prioritize the spending that you have over here. So how important on a scale of 1 to 5? You don't watch cable anymore because now all you do is watch Netflix. So on a scale, 1 being most important, 5 being least important, maybe cable is least important. Netflix is most important, DoorDash kind of 3, you could take it or leave it, whatever it might be. So you kind of prioritize your expenses, and that helps you then decide what you should cut first. Okay, so now that we have those 2 lists, so you've gone through, you've figured out your expenses, the next thing you're going to want to do, and this is the second step, is you're going to need to begin to pare back some of your expenses and cut your expenses. The problem is for a lot of people, there's not a ton of fluff in their budget. And so that makes it difficult. So there's a couple steps that we can do. So the first thing is there anything we can cut? So we can cut cable TV. So we're going to put that there, $50 a month, probably cheap for cable. And we're going to go ahead and just delete it from there. We can copy and paste actually if we wanted to. We're going to spend less on DoorDash. So we're going to do $250 on DoorDash. So we're going to do $250. So now we've cut it. Problem is we've saved $585, or we now have $585 of extra income a month. The problem is you probably need even more than that to live or to save. You probably need to save more than that. I can't talk. So the next step we want to take is, are there any things on our list, maybe a fixed expense that we could reduce the price of? So for example, cell phone. I know I pay almost $80 to $90 getting my cell through AT&T, but one of my friends has his cell service, almost identical service through Verizon, or not. It's Verizon service, but he gets it through Comcast. He pays $30 a month for that. So, let's say we could reduce the cell. We could reduce it to $30. So here we are, let's put 30 here. We don't really need to track how much we cut and reduce, but it just I wanted to give you a visual. So then probably can't cut water. Groceries probably can't cut. Electricity, we might be able to cut by using a little less. Same thing for gas. But internet, it's one of those things you might be able to renegotiate your internet. I find that if I call and tell them that I'm going to cancel, they'll often throw a deal at me. So let's say internet, we're going to save $50. And there we go. Oh, the one other thing, car insurance. Forgot car insurance. One of the easiest ways for me to save money for clients is on car insurance, either switching to Geico or Metromile. So let's say you're paying $100 a month. We can cut that down to $50 a month. So this kind of gives you an overview. Let me switch back over to my primary video.
The third step now, so we hopefully freed up a bit of money in our budget, but maybe we don't have quite enough to save. So the third step is there any way you can earn more money? And you can do that in a variety of ways. One thing you could do is possibly go to your current boss and say, look, because of inflation, because of whatever the case might be, because I'm doing an incredible job, I haven't received a raise in 5 years, is it possible for me to get a raise? The second thing you could do is, if your boss isn't willing to give you a raise, or even if they are, maybe it's not going to be enough, you could try to find a new job, potentially even change careers. I know you're a bit far along, so this is going to be a little bit harder, but one of the easiest ways to actually kind of step your income up research has shown, is to actually change jobs every few years. So maybe you could switch to another employer, keep doing the same job that you've been trained for, that you have experience in, but maybe receive more money for doing the exact same job. So maybe look into getting another job. The third thing you can do is begin to create passive income. And there's all sorts of ways to create passive income. I'm going to make a video in the near future on different ways you can create passive income. But two of my favorite ways of creating passive income are, the first is Airbnb, often just renting a room out in your house. So I've done that in the past. We had an extra bedroom that we weren't using, and it freaked me out at first, the idea of having someone else living in my home. But the people were all excellent. It brought in a lot of extra revenue, because often you can, depending on where you live, you can make an extra $50 to $75 to $100 a night renting a room out. So even if you're only doing it, say 10 nights a month, you could bring in an extra $500 to $1,000 just renting out an extra room. You might be able to convert your garage into a little studio, whatever the case might be. You might be able to find a way to earn some extra passive income that can be ongoing, that won't take a lot of work through Airbnb. The other thing that some of my clients use is a service called Turo, where you actually rent out your car, kind of like Airbnb, but for cars. And so maybe you have an extra car sitting around and you can put that on there and get some extra income. One of my clients gets an extra $500 a month renting out his old car, because sometimes people, if they're in an accident or they just need a car to bum around town for a few days, they go on Turo, get a car, and even though it's not a fancy car, they're just looking for something cheap and efficient to get them around town. So look into ways of creating passive income, and YouTube is a wealth of information on ways you can create passive income. So the third step is, can you earn extra income? So we've figured out where our money's going. We've begun cutting our money. Hopefully now we're earning some extra income. Now comes the fun part. We want to take some free money. Often your employer has a 401k plan, and in that 401k plan, if you participate, your employer will often give you a match. So if you put in 2%, you should put in 2%. If you put in 2%, your employer will match that 2%. So if you have a 401k plan at your employer, and if they'll be willing to match it, max that to the maximum. So even if you've not saved any other money, you're not saving anyplace else, go ahead and max that out. Take the free money and begin contributing to your 401k plan. Okay, so that's step 4, take free money. Step 5 is pay off any revolving debt that you have. So before you invest any other money, pay off your high interest debt. So if you have credit cards that are costing you a lot of money in monthly interest, or you have maybe a boat loan or something else that has a high interest rate, go ahead and pay that off. So the 5th step is get out of debt, and that's going to help you a lot as you prepare for retirement. So now hopefully you have some extra money in your budget. You're taking the free money from your employer if you're one of the lucky ones that gets that from your 401k plan. Then the next step is get out of debt. Now step 6. This is where we get to have a bit more fun. Now we've got some extra money, you're earning extra money, you're saving some money in your budget. Now we want to max out some of our investment accounts. And so the first investment account, once you've taken your match with your 401k, unless you need the tax savings, which for most people, unless you're earning probably $200,000 to $300,000 a year, I wouldn't recommend starting with the 401k. Except to get your free match. You want to get the free money if there's matching. The next thing you want to do is max out your Roth. So if you qualify for a Roth, go ahead and max that out. If you earn too much to qualify for a Roth, there's still a way you can contribute. I'll link to the video where I explain how you can do that. It's called a backdoor Roth. But what you want to do is you want to max out your 401k. If you're over the age of 50, you can put in $7,000 for you, and if you're married, you can put in $7,000 for your spouse. So that's $14,000 a year you can put into a Roth. And here's why you want to put money into a Roth, because all the earnings, all the capital gains in that account are going to come out tax-free in retirement. So if you put in $14,000 a year beginning when you're 50, and you do it each year, and that money continues to grow and grow and grow, and then at retirement you have this nice nest egg, you can pull all that money out tax-free. Whereas if you put it in a traditional IRA or 401k, that money's going to grow, and you're going to get a tax deduction in the front end, but that money's going to grow, and when you go to take it out in retirement, you're going to have to pay taxes on it. And in fact, not only do you have to pay taxes on it, but they force you at a certain age to begin pulling that money out of your account. And that can sometimes mess with your income, because you'll have to take money out, which will be counted as ordinary income. And that could cause, not saying it will, but it could cause your Social Security to be taxed. And so if the more money you can get into a Roth IRA, the better. So max out your Roth IRA. So let's say your employer will match you up to 5%, which would be incredibly generous. And if you have that, you're lucky. But let's for easy math's sake, let's say that's the case. So you're 50 years old. Your employer will match you up to 5%. So you put in 5%, they'll match 5%. So you're putting in $3,000 into your 401k, and then you're going to put in another $14,000 into your Roth IRA. So that's kind of where we are right now. We're on step 6. Now, if you have extra money, let's say things are going really well, the boss gave you that raise, you're saving a ton of money in your budget, the next thing I would do is open up a taxable brokerage account and begin putting money in there. Before, I would probably max out my 401k. It gets a little tricky because if you're earning over a certain limit, it makes sense to put your money into your 401k because of the tax break. But if you're in a lower tax bracket, it might not be worth it for that tax savings, and you might be better off putting your investment money into a taxable brokerage account. Okay, so that's the sixth step. Okay, now step 7. And in step 7, we really begin to put everything together. So it's kind of a catch-all category. So we're going to look at a couple of things. One of the steps for step 7 is you probably need to work longer. So instead of retiring at, say, age 62, you probably want to wait till age 70. And so what I'm going to do in this step is I'm going to show you exactly what that would do to your Social Security, how much more it could mean in Social Security payments. And then also I'll show you what a difference it can make in investing, your investing returns. And then I'm going to show you 2 different resources that are free. And so what you're going to be able to do with these resources that I'm going to show you is you'll be able to understand the impact of contributing a certain amount of money. So, I started off by talking about how you need to figure out where your money's going so you can save some more money. Now you'll actually be able to see how that money can grow and what that could potentially grow into, to give you an idea of what you might want to save to kind of keep your current standard of living. So I'm going to switch over to my other screen now and kind of walk you through these resources that I use.
Okay, I think I'm back. Now, one of the things you can do, I'm going to be just playing with some fake numbers, but you can actually find exact numbers. If you go to My Social Security, let's see right here, I will put this link in the show notes, and you create an account, you can download a report from Social Security that will tell you exactly what your estimated Social Security payments would be based upon if you retired at age 62, 63, so forth, all the way up to age 70. But we're just going to use an estimator here just to kind of give you an idea. So we're going to use the quick calculation. So we're going to say, if you are age 50 today, that means you were born in 1972. You're earning $60,000 a year. You're still working. And let's go ahead and submit the request. So this will give you an idea of how much you can expect in monthly Social Security benefits. So if you're 50 today and you're retired age 62, you could expect about $1,300 a month in Social Security benefits. But if you waited just 8 more years till age 70, let's see, I don't want it inflated. I guess it was on the screen. You can see you earn $2,500 a month, almost double. And these are in today's dollars. So if you want to see what the inflated numbers would be, you could have almost $5,000 a month in Social Security income if you wait till age 70. So that's the first benefit of waiting a little longer to retire, is you can just expect a significantly higher payout from Social Security. Now, there are a number of things that go into that calculation. And so if you're in poor health and you don't think you have a long retirement period because of your health, you might want to take it earlier, go ahead and get as much money as you can up front. But if you have good genes and your family lives to be 100, you definitely want to wait. Even if you retire earlier, you want to wait until age 70 to take the Social Security benefits. There's also some strategies around one spouse taking it now, another taking it later, but that is beyond the scope of this video. So the other thing I want to do is I want to show you this resource here from the federal government. It's a compound interest calculator. So I want to show you the difference of waiting a few extra years in retirement makes, both for compounding and then also for just the growth of your money. So let's say you have been able to figure out you're going to max out let's say you're married, you and your spouse are both going to max out your Roth, and you're putting away $3,000 into your 401k, your employer's matching it. So you have $6,000 in a 401 going into 401k each year, and you're maxing out you're maxing out your Roth. So you are putting in approximately $1,750. I'm just going to say $1,750 for easy math each month. So you're putting away $1,750, and you're going to do that. If you retired age 62, that would be 12 years away. And your interest rate would be the return of the market. Historically, the stock market has returned, the S&P 500 has returned somewhere around 9.5%. So we're going to go ahead and put 9.5% return. And over 12 years, at the end of that time, you should have $435,000. And so if you take that and you annuitize that payment, you could count on maybe, $20,000 to $25,000 in income on top of your Social Security. So you're getting closer to your retirement goal, but you're probably still not there yet. Where on the other hand, if you wait another 8 years and you both giving you more time for the money to compound, but also more contributions. So let's say you wait another 8 years, which takes you to age 70, you could have $1 million in your account. That's a significant amount of money. And probably if you're living on $60,000 a year right now, that's going to be more money than you could possibly need, or more than enough money to retire well, along with Social Security. So the longer you wait, you give that money more of a chance to compound. Now, here's the great thing. Let's say you put the money into the Roth and you're making these contributions. And so you go to retire and you got $1 million, but you're living really frugally. And so you're not using that money for another 10 years, but you've got $1 million. And I love this calculator. I could play with it all day. And so, at age 70, you retire, the market continues, your money continues to grow. You have $1 million in that Roth, but you're living off your Social Security. Maybe you create some passive income. You're renting out a room on Airbnb. And so you don't end up needing to tap into your retirement income. That $1 million could grow into, put the wrong initial investment. That $1 million could potentially grow into $2.5 million by the time you're 80. And that's where people are able to create legacy, even people who never really had a lot of money. Because remember, you never really put anything more than 5% into your 401k and maxing out your Roth each year. And you didn't start until age 50. But even then, with kind of an average market return, now these are high, but this is what the average is over a long period of time, but it's not a guaranteed return. But you could create some significant wealth. And so that's why it's so important to find room in your budget to begin saving today, because the longer you have to save, the more money you're going to have in a retirement, but more importantly, the more money you're going to be able to use to create a legacy, either to donate to a foundation, maybe create your own foundation, pass money on to family, whatever the case might be. So I'm going to switch back over to the main camera, see if I can figure out how to do that.
Okay, so just to recap, the first thing you need to do, the most important step, is figure out where your money is going. Too few people know exactly where their money is going. And once you have a good understanding of where your money is going, you can then be intentional about your spending, reducing your spending, and creating more money to save. Then once you've figured that out, you can then begin to cut some of your spending, save some more money, and then you can begin to invest in your 401k plan. You can pay down your debt. You can invest in a Roth IRA. You can invest in a taxable brokerage account, and then figure out how you can also create more income, whether passive income through Airbnb or Turo or a million other things, like I said, you can find on YouTube, which will give you even more money to invest. And then explore, okay, how much money do I think I'm going to need to retire? And then using these calculators I showed you and the Social Security estimates, and that will begin to help you understand exactly how long you should work. And even if you decide to retire a bit early, you might still want to wait and to withdraw Social Security, because it will really maximize your benefit. So I know this was a lot. I dumped on you. If you ever want to chat, you can always reach out to me. I always do like a free 30-minute call. You can email me, kevin@foundryfinancial.org. I'm always happy to chat with people. My goal, as I said, is to help 1 million people retire without worry. We're working on a few different training sessions and all kinds of fun things. So if this content was helpful to you, I'd really appreciate it if you would click the like button, subscribe, and then ding that bell. All those tell the YouTube algorithms that you enjoy this content. Leave a comment below if you have a question, and then share this with your friends and family. Thanks for watching.